very good morning to everyone. As you just heard, my name is Wilfred Frost. I was recently an anchor at CNBC and now with Sky News. And my pleasure to be hosting this panel discussion on broader macro markets and economic themes. Alongside me, we have Charlie Morris, immediately to my left, editor of the Fleet Street Letter, also founder of ByteTree Asset Management, and formerly managing £3 billion for HSBC. Before that, then Gerard Lyons, Chief Economic Strategist at Netwealth, which is a challenger wealth manager, and he's a shareholder founder there, as well as strategist, and Savvas Savouri of Toscafund, where he's a partner and Chief Economist. They've got £4 billion of assets under management. So we're really looking forward to diving into this discussion with you all. Very good morning to you guys.
Morning.
Morning.
I thought we heard the word inflation there. I feel like it's the crucial area for markets probably of the last 6 months, though of course many others have been thrown in as well of late. And Gerard, to start with you, this past week, 2 interest rate hikes from the Bank of England and from the Federal Reserve, and rates rising quite significantly, but still historically low. How do you gauge where we are with that in mind? Is this groundbreaking rise in rates, or is it small in the grand scheme of things?
Well, good morning. It's great to be here. Both in terms of inflation and rates, there are 2 separate issues. Obviously, what happens to inflation would determine the trend for interest rates. Thankfully, at Netwealth over the last year, we've been on the ball in terms of the inflation outlook. Inflation has proved more of a risk than the market thought. The way I characterized it over the last year was, which P is it? Is the pickup of is the rise in inflation passing through quickly? Will it persist, or will it be permanent? And linked to your question, the challenge for central banks has been that they tended over the last year to think that inflation would pass through quickly, and they were wrong. It was quite clear over a year ago that inflation was likely to persist, and it's going to persist for some time. And I think inflation will head significantly higher, not just this year in the UK, but in most Western economies. The challenge, therefore, really for markets is, what does it imply for interest rates? In recent years, we've seen unconventional monetary policy. Interest rates in the West have been anchored around 0. And the big debate is, against this backdrop of rising inflation, do interest rates go up to where the market's now thinking, around 2% or so, or should interest rates head significantly higher? I think the markets are right to assume that the increase in interest rates will be gradual. The States has indicated sort of 6 or 7 rate hikes. The Bank of England's behind the curve, has been too slow to act. But I think beyond this next year or 2, the challenge for any investor is that interest rates do need to settle at a much higher level. Around 4% or so is where they should be settling in the UK and in the States. But if we're thinking over the next 12 to 18 months, it's gradual, predictable increases in interest rates up to maybe 2% or so in the States. In the UK, because the economy might be weaker, UK interest rates will probably not reach that level over the next 18 months.
And Sav, what's your view on the same topic? Clearly, where rates are today and where inflation is today is one thing, but it's also what the market expects to happen. And have expectations caught up with reality, or is there still a big gap to close there?
Well, the context is that we had the 08 crisis, and we really didn't really escape from the post-08 monetary environment. Then we had COVID. Now, before COVID struck, there was a discussion, an active discussion, Lawrence Summers being at the head of it, about raising the inflation target. So if the question in the UK is, where will inflation surge to? The question really isn't where it will surge to, is where it will stabilise at. And it would be nice to know that the Bank of England can actually move its inflation target from a range of 1 to 3 to a range of maybe 2 to 4. Because if it's 2 to 4, we will stabilise at the top end of that range. And don't forget, we're demanding supply security, both for food and for energy. We want to be more environmental and more ethical. And you can't do that without inflation. Mm-hmm. So maybe 2% is too low. Now, but the conclusion is this. If the question is where we're going to be in 2 years' time, it's the Eurozone will be in deflation, the dollar zone will be in stagflation, and the sterling bloc, comparatively small, will be nice and comfortably out of those 2 buckets.
And before we get on to the next question, if my voice is carrying to the entrance, just encouraging everyone who's just arriving, please come and join the main stage and listen into to this discussion. Charlie, just break down for us, if we do have this high level of inflation that clearly Sav and Gerard expect over the next couple of years, whether that means you should be buying equities because they tend to be real assets and move with inflation, or whether, in fact, you should be avoiding them because it might pressure multiples.
Thank you, and pleasure to be here. I mean, should you be buying equities? Well, which kind of equities would be one of the answers to that question. I would just go back a stage and say, why is the Turkish stock market on circa 4 times earnings, where the American one is closer to 20 times? And one of the answers would be inflation. And high inflation countries tend to have much lower valuations on their stock markets and, of course, on their bond markets. And so you have much higher yields. And that's an extreme example, but we're going from ultra low yields to normal. And even if inflation was low in the Western world, rates shouldn't be zero, they should be something. So there should be some sort of real return from owning bonds. So the whole world is mispriced. And rather than going to normal, back to some sort of neutral situation calmly, we're now going in a panic because the inflation is out of the bag. I think inflation is like a game, the children's game of whack-a-mole, where it pops up somewhere, you solve that problem on the supply chain, then it pops up somewhere else. I think that it's wrong to think of inflation as being 5% or 10%. I think it's right to think of it as 5 or 10% over a period of time and with a lot of volatility. So it will burst up, that will crash the economy, then it will cool down, then it will resurface somewhere else. And all of this adds to uncertainty, which basically is bad news for stock and bond valuations. Now, the good news is, of course, there are sectors, and we'll get to that, which think differently from the mainstream stock markets and bond markets.
Sav, just wanted to touch on, the number of rate hikes we're likely to see over the next 18 months, whether we look at the Fed dot plots or some commentary from the Bank of England, as Gerard referenced, probably 6, 7, 25 basis points hikes. Is that enormous in the grand scheme of things, or is it only enormous given that we've been so used to low rates in the last couple of years? It'll only take us to 1.5%, 2%.
Well, again, we talk about nominal rates, but we should be thinking in terms of real interest rates. And in that regard, even as we move up for the UK, we're going to still be in negative real rate territory. We have to think of it in that context. And also, I'm of a generation when the risk-free rate was 7% when I began my career 30 years ago. And since then, what's happened is things have been introduced, globalization, the internet, which have been forces for disinflation, if not deflation. Bear in mind, until quite recently, the spectre of deflation was the one that we wanted to eliminate. So again, we must bucketize the dollar block, euro block. With apologies. So we've got to separate out the dollar block, the euro block, and the comparatively small sterling block. And each will have a different inflation issue or challenge. Mm-hmm. Another thing is, we're talking about the short end of the yield curve. We should be talking about the long end of the yield curve as well. And it's not unlikely that you could get some inversion going on in the next 18 months.
Yeah, I mean, already incredibly flat in the middle of the curve in the US. A lot of discussion on that.
But if I could come in on that. The reality is monetary policy has been far too loose for far too long. Since the global financial crisis, we've had unconventional monetary policy. Central banks have been asleep at the wheel, and it's caused major problems. It's led to asset price inflation, particularly in the UK, rising house prices, rising asset prices. That's added to inequality. In terms of financial markets, it's created the backdrop for financial instability, both because policy rates are too low and because central banks have, through quantitative easing, been the biggest buyers of government debt. And on top of that, as we've touched on, central banks have been too slow to respond to the inflation problem. So getting from where we are now, where rates are too low, monetary policy is too loose, to where we should be is going to be very painful. The flip side of that is politicians won't like that pain. So we're likely to go from unconventional monetary policy to unconventional fiscal policy, with governments in Western countries, particularly on the continent, it has to be said, it's already happened to some extent here, basically pushing fiscal policy as far as they can. So markets and investors have to contend with the fact that monetary policy is too loose, it's created this backdrop where markets are not pricing properly for risk. And as we've seen this year and in recent years, there are lots of risks out there.
And Gerard, on that topic, I mean, let's bring in, the terrible events that of course are going on in Eastern Europe at the moment and the relevance of that for markets. Clearly, there's hydrocarbon price inflation, also going to be significant ag price inflation, which I know some of the panels later will be addressing as well. Gerard, is it now base case that we have a recession in continental Europe? What is the likelihood versus the UK and the US and continental Europe for a recession in the next 18 months?
Okay, well, the risk is that there will be a significant, well, the likelihood is there's going to be a significant slowdown both on the continent and in the UK. And the risk is that there could be a recession if policy is tightened too much. What the war is doing is it's adding to inflation problems near term, as that limits people's ability to spend. And also at the same time as it adds to uncertainty, it will slow the economy later. If you look at exposures to the problem in Ukraine and Eastern Europe, it's largely European banks. If you look at the Bank for International Settlements data at the end of last year, the total bank lending to Russia was $124 billion. The bulk of that was France, Italy, and Austria. The UK's exposure was only $3 billion. But as we've seen in previous crises, the interactions are relevant in terms of how others are exposed, and that often takes time to come through. So it will add to stagflation worries, not at the same time, inflation first and growth worries later. But despite all that, the reassuring issue is this. Financial markets take a hit, but economies tend to be very resilient. We've had a global financial crisis, we've had a pandemic, now we're having a war. But what you actually see is the underlying strength of the world economy does come through. Admittedly, more of that growth is trans-Pacific, shall we say, the Indo-Pacific region, India, China, the US. And that's why the UK needs to reposition itself. But in answer to your question, the region that is exposed the most is definitely Western Europe.
Charlie, I wanted to ask now about the case for gold and crypto, particularly in light of the war, not just because of the inflationary and recessionary factors that we just mentioned, but also the sanctions that were imposed on Russia, in particular the freezing of their central bank assets, essentially US treasuries. Was that a potentially game-changing moment for the case in the years ahead for crypto and for gold?
I think so. I mean, gold doesn't need to prove itself. It spent 5,000 years doing that. And gold has behaved, I think, very well. Some people are confused that gold didn't go up in 2021 because there was lots of inflation and gold actually was flat on the year. But you only have to go back to 2018, 19, and 20, and gold was up 50%. And that's because gold saw all this coming. It always does. Gold is a genius forecaster, even better than these great economists I'm sitting next to. Gold always gets it right. And so gold's doing its job quite well and is trading in line with how you'd expect it to. But Bitcoin is something slightly different. There's crypto and Bitcoin. We'll talk about Bitcoin. Crypto is a big subject in its own right. And Bitcoin is clearly the king of the asset class, is deemed as a monetary asset of the digital space. Yes, it's very volatile, less volatile than it used to be. But here's the thing. Bitcoin is trading at $41,000 today. Now, if you go back to previous downturns in Bitcoin, you'd expect it to be about $10,000 by now, and it's not. So the fact that Bitcoin is basically comparing itself to the NASDAQ is telling you it's grown up a hell of a lot since 2018, the last downturn. So I think Bitcoin has come through this with flying colors. And yes, you can transfer Bitcoin across borders, but more importantly, you just can transfer it between computers. So you don't have to just jump onto the sort of evil notion that it's helping Russia evade sanctions. In fact, it isn't. The Bitcoin network is not nearly big enough to absorb Russia's vast $600+ billion of reserves. Not nearly big enough. In fact, there are 4 actors we can look at in the Russia-Ukraine conflict. The Ukrainian people, the Ukrainian government, the Russian people, and the Russian government. Now, 3 out of 4 of those are goodies. 1 out of 4 is a baddie. It helps the 3 goodies much more so than it helps the baddie. And I think the final point I make is that Bitcoin and gold are best friends. They're not enemies. They're not in competition. One is established with the global central banking system. Gold is a part of your lives whether you like it or not. It's also in the jewelry, in tradition of marriage and store of value around the world in poorer countries. And it's been with us for a long time, and there's industrial application. But this is an important part of the monetary system and always will be. Bitcoin's up and coming, and it's a private asset. No central bank owns it, and basically no institutional investors own it. A few family offices may be, but all the big names in finance do not own Bitcoin. So that's all to play for. It's going to be much bigger in the future, and I think this recent terrible episode does demonstrate that actually there's a need for an alternative financial system.
Sav, wanted to continue the discussion on the impact of the current crisis in Eastern Europe and pivot perhaps to Asia. Those central bank sanctions that we just mentioned on Russia, no doubt everyone around the world has taken note of them, but China in particular. Do you think China, the outlook for China, both economically and their investable assets, has improved or worsened over the last 6 months or so, both in light of central bank sanctions on Russia and also the inflation debate that we've been having?
Let me start by just making one point about cryptocurrencies and in particular Bitcoin. It's sorcery, it's alchemy, it's basically a fallacy. So,
Rubbish.
and
I'm sorry, sir. I spent 8 years
It'll make
studying
you
it.
very poor.
No, you're not getting away with that one. I think you've got to understand.
I've not finished yet.
you're-
You've had your chance.
Yeah.
China. They say...
Well, let's pause China because this is a good debate.
The spoils of war go to the victor. There is the competence in this battle will not have the spoils of war because there won't be a victor. The victor thus far and going forward will be China, because what's happened is that you're seeing the Saudis discussing with China de-dollarizing oil. You're seeing China go from being a monopolist buying Iranian oil to being a monopolist buying Russian resources. China has had it away over the last 4 to 5 weeks.
Let's continue. I should have gone straight into this crypto debate, but Sav, outline a little bit more detail why you're so bearish on crypto assets.
Well, first of all, do I believe in blockchain? Yes. Do I believe that we're moving into an era of central bank digitalization of currencies? Yes. So the very blockchain technology that gave birth to cryptos and Bitcoin will kill the thing off, because according to Gresham's law, you simply can't have a digitalized sterling or dollar or euro or yuan and also have an alternative digital currency, because, as Gresham's law says, dirty money will go through the channels that are unregulated. China has already cancelled cryptos. Yes? Good luck if you believe in Bitcoin, because you can all go and live in El Salvador.
But you've also got assets like gold that don't necessarily, other than jewelry, have a fundamental use, and they've lasted a long time. Have we, Gerard, crossed a crucial line with some of those assets? That bear case that Sav outlined has been around for 2 or 3 or 4 years, and the price has not only soared, it's sort of stabilized in a very volatile way in the last couple of years, despite a lot of challenges.
Okay, I think it's important to differentiate between these. Investors can actually avoid going into gold or crypto and take advantage of many of the opportunities if they're fully invested, if they're diversified. Gold clearly has a place in a global financial system. I did a major report on this for Chatham House back in 2012. Gold, in terms of investors, tends to do well when real yields are low, when uncertainty is high, and often when there's uncertainty about the dollar. At the moment, the dollar is pretty firm. But gold has a role to play, particularly when people are worried about inflation and worried about the financial system.
So is it a good time to buy it now?
No, probably not, because, well, let's put it this way. As part of your main portfolio, you shouldn't have gold sitting in there. But if, in terms of looking at, in terms of your speculative part, there's always a case. But it's probably fully discounted, shall we say, at the moment in terms of the price. But crypto is a very different thing. And I completely agree with the point on my left here. One needs to differentiate between the shadow system and the real system. And crypto's time is partly there because the space has not been occupied by a system where central banks have come to the fore. As central banks develop their digital currencies, then that will actually start to raise questions about crypto. But crypto's response then is to move to a more regulated environment, onto ETFs, etc. At the moment, it's very difficult to price, and there's a whole plethora of different cryptocurrencies. So in answer to your question, it's the point made originally, there's an opportunity for it, but it needs to change in its format. If you're an investor looking at it, you should go in knowing that it's completely speculative. And it's toss the coin. If timing is going to be an issue. What investors should be looking at now is a very different bespoke. At Netwealth, where we've had very good performance, is about being fully invested, it's been diversified, and it's been global as well as focused on the UK. That gives you enough backdrop. Gold, you can work out the correlations with other assets. With crypto, it's far more difficult to do that. Hence, it's a higher risk. And people should be fully aware of that.
We've got a good spread there of views on crypto and Bitcoin, but I want to pivot back now, Charlie, to equities. Probably should be the bulk of most people.
May I just answer the
final point on
very
crypto.
quickly on Bitcoin?
Yeah.
I think, you know, where is the intrinsic value in Bitcoin? It's in the network. And I think that when you bring hundreds of millions of people together, there's something very valuable there. When we first looked at WhatsApp being bought by Facebook for 18 billion about a decade ago, it seemed crazy. There were no profits associated with it. But that network turned out to be a bargain. The idea of transferring value between computers is not going to go away. And I know it's very hard for people to get their head around it, that Bitcoin is now a pretty mature asset. The infrastructure around it is first class. And there are many, many points of regulation in the system, although Bitcoin itself is not regulated, nor ever could be.
Let's hit equities now. And for all these points that we've discussed, are they still the best place to put the bulk of your portfolio? And Charlie, the last 10, 12 years, basically post-global financial crisis, the US has massively outperformed the rest of the world. Is the decade ahead of us going to see that reverse or change direction?
It should do. It should change because of what we were talking about earlier, which is higher interest rates. These great tech stocks that dominate the S&P 500, it's only a few names that are a quarter of the entire index. They are on high prices, and they're no longer being priced as growth stocks so much as the new Unilevers or the new Diageos. They're seen as high quality, interest rate sensitive stocks. Their growth rates indeed are not that high. I'll give you an example of Microsoft. Microsoft in the year 2000 had a 2% free cash flow yield. It went on for the next decade to grow not at 30% like it had done in the 90s, but at 15% over the next decade. And the price of Microsoft over the next 9 years came down 75%. This is fact. You might not remember it, but it happened. Now today, Microsoft is on a slightly higher free cash flow yield of nearly 3%, but was 2% not so long ago, and it's growing at that sort of 14%. You know, so Microsoft could very easily go down by a half or more if we had a change in the cost of money. And that is true for all these big companies from McDonald's, all the well-known global brands, which I kind of trade as a bit like inflation-linked bonds, basically. They're at the wrong price. So the value investor stands a much better result over the next decade than they did over the last, because that's what works in a rising inflation, rising interest rate environment.
So which country or region or sector would be your top pick for the 2 years ahead?
Well, if you'd asked me a month ago, I would have said UK and emerging markets. If you ask me today, I'd say UK. Emerging markets, something's gone wrong there. You know, Russia was the cheapest of them all. That's suddenly gone to zero. India's popped up, and you know, they're sort of neutral in this global geopolitics. What does that mean? We don't know. That's a highly rated country. That could be a problem. And then you've got China, which is possibly not quite as friendly as we thought it was. And so I think that mainstream emerging markets probably are now riskier, even though they're cheaper. But you have to look to countries which really are very much our friends to capture that value. So I think non-BRIC emerging markets and UK is probably the geographies that I would favour.
Gerard, do you have a different view on China?
I would be fundamentally bullish on China. Look, let me give you 3 figures, and these 3 figures should tell you why you should go away from here, despite all the near-term uncertainty, despite the fact that central banks need to tighten monetary policy. You should be thinking longer-term positive. The 3 figures are 32, 63, 103. What are they? $32 trillion was the size of the world economy in the year 2000. $63 trillion was the size of the world economy the day the financial crisis started. $103 trillion is the size of the world economy at the beginning of this year, according to the International Monetary Fund. Despite all the crises, despite all the problems, the underlying trend of the global economy is positive. Where will the growth be? in answer to your question on China, the growth region is the Indo-Pacific, from India in the west through China to America in the east. The other big driver is the digital and data revolution, where the US is ahead of the game and China is trying to catch up. The UK, against this backdrop, needs to position itself. Western Europe, not just because of Ukraine, is the slow growth region of the world economy. The UK is incredibly cheap because sterling looks cheap. But if monetary and fiscal policy are tightened too much this year in the UK, then sterling could unfortunately become even cheaper and UK assets could become even more attractive. I agree with the attraction of the UK, but emerging economies do look attractive. One clearly needs to differentiate. The Chinese economy is decoupling because of the global financial problems as a result of the central bank assets being frozen. But this year, do bear in mind, China has a zero COVID policy, is looking for stability ahead of its big October political meeting. That could dampen growth. But unlike Western economies, China has lots of room for policy maneuver this year, both on interest rates and on fiscal policy. But the point is, we can look at the different sectors, we can look at the different economies. The underlying trend of the global economy has been up. There will be volatility in the near term because central banks have to tighten policy. But despite that, you should be looking to be longer term, global and fully invested.
And I know we're right up at 10 a.m., but Sav, time for a final thought, which I'm very happy for you to take wherever you want to go, but included, if you can, with your outlook for the UK, given all the challenges that we've mentioned. Is it bearish, or in fact we'll be all right?
Well, let's forget about bearish and bullish. Let's be realistic. For a recession to happen, you need one of three sectors to malfunction: property, labour, or banks. And all three are incredibly fine fettle in the UK at the moment. Rising rates actually favour banks. Labour market has a problem, which is that it's got 1.1 million vacancies it needs filling. You've got wage inflation coming through, driving disposable income. So those of you who believe the UK will suffer a recession will be mistaken. Those of you who expect the Eurozone to do well will be wrong. Those of you expecting the US to continue to print debt and to have ready buyers will be wrong. Those of you understating China will be wrong.
So you're bullish UK, China, but bearish Eurozone and US. Realistic, sorry, I can use wrong words.
250 is the target of private equity money. We are being de-equitized because we're too cheap, both through currency, as Gerard said, and all through valuations. The likes of KKR and all the other the myriad of other PE firms are coming along, and they're basically taking out of the UK stocks and assets which they see as undervalued. Always follow the smart money.
Well, we're out of time on this panel, and it's been fascinating to me. I hope it has been to all of you. And I know there's some amazing conversations coming up later in the day, some amazing boosts for you to get some more financial investor advice. If, by the way, you want something different during the day, I highly recommend the Duppy Share Rum booth, which will give a slightly different, maybe not for the morning sessions, but the afternoon sessions. Full disclosure, it's my little brother's rum brand. But I highly recommend going over to that at some point during the day. But we are out of time on this particular panel. Sav, Gerard and Charlie, thank you so much for your time. I'm sure everyone here will want to join them and thank them for their wisdom this morning.
Thank you very much.
Thank you.